There are 10 crucial questions you must ask before you buy an investment property or you risk buying blind. In this video, I'll walk you through each question step by step using real property examples inside SuburbsFinder's property analyzer tool. No fluff, just practical insights backed by live data. If you stay until the end of the video, I'll show you how to find the best locations after running the numbers just by clicking one button. Can I afford this property based on my loan terms? Let's take this property listed in Albury for $700,000. But first, we need to check if the property is in a good location or in a safe area. So that is this property. So it's close to these childcare facilities and close to this school, and at the same time, it's close to the healthcare facility. Next, we'll check is it on a heritage zone? So it's not on a heritage zone. What is it on a landslide zone? It's not. Is it on the flood maps? It's not. Is it in a bushfire prone area? It is, but it is on the buffer of the bushfire area, as you can see here in the legend. Next is, what's the zoning of the land? So currently it is on R1, which is general residential zone. So we can now use this because it's a good example of a property. So we'll click analyze. It's automatically plug in the advertised price as a price. And then we'll set the loan term to 30 years and the interest rate at 6.7% on interest only for 5 years. So the tool automatically calculates our monthly repayment both during and after interest only period. If we don't know our repayment obligations under different loan types, we could end up over leveraged or surprised by cash flow shortfalls. Understanding our loan terms helps ensure the property fits our financial capacity now and in the future. I remember a friend of ours bought a townhouse thinking the repayments were manageable, but didn't account for the jump after interest only period. And within 6 months, he was dipping into savings to cover repayments. If he had used this process, he would have seen the spike ahead of time. What are my upfront costs? Stamp duty is automatically calculated here. And I'll add solicitor's fee. And if we're using a buyer's agent, we can add a buyer's agent fee here. But for this example, let's just make this as 0. This gives us our total upfront cash required to purchase the property. If we underestimate upfront costs like stamp duty and legal fees, we might stretch our budget too far or run into settlement issues. Knowing our total cash requirement upfront keeps our finances in check. I remember a couple I work with had budgeted for the deposit only. They completely forgot about stamp duty. It delayed their settlement and cost them an extra $7,000 in bridging finance. This tool shows it up front. How much rent can I expect and how will it grow? The property analyzer tool automatically pulls the median rent per week, which is $550, and then we can put here the projected annual increase. So let's say we put in the 5%, and then let's see what will be the effect on cash flow. So let's click show charts. Let's just deactivate the P&I component so that we're just focusing on interest only. So as you can see, on a 5% projected rental increase, our cash flow will look like this and will be positive after tax on 2035. And when we change our projected rental increase per year, so let's say at 1%, you can see the effect in our cash flow. So instead of 10 years, so it will be positive on year 21. Rental income determines our cash flow and return on investment. If our assumptions are wrong, our investment might not cover its costs. Projecting rent growth helps us forecast future income more realistic. One investor I know relied on a high rental figure from a real estate agent, but the real rent was less by $80 per week. With this step, you can start with a realistic baseline, not hope. How will inflation, vacancy rates, and interest rate changes impact me? The vacancy rate is sourced directly from SuburbsFinder's database, while the inflation rate is fully customizable, either per year or across a 30-year horizon, allowing for flexible scenario testing that reflects changing economic conditions. Economic conditions affect every investor. Being able to test worst case scenarios for vacancy rate or rate hikes helps us stress test our deal and protect our investment from risk. During the 2020 and 2023 rate hikes, I saw landlords go from positive to negative cash flow almost overnight. If they had modeled even a 2% rate rise earlier, they could have been better prepared. Will I be positively or negatively geared? And when? By entering the owner's taxable incomes and ownership split. So let's say my taxable income is 120,000 and the ownership split is 50-50, and my partner's taxable income is the same, 120,000. The analyzer computes the after-tax cash flow projections each year, revealing exactly when the property becomes negatively geared or positively geared. So on this scenario, we're just factoring in the interest only component. So after tax cash flow, we are going to be negative for the whole 9 years. And on year 10, will be positive after tax by 495. And that is based on our taxable income. Knowing whether our property will cost us money or make us money after tax is critical. This directly impacts our ability to hold the property long term without stress. A person I know assumed his property would be positively geared from day one, but forgot to factor in insurance and property management fees. Using this tool, we found out it only go positive after year 4. What will my property be worth in the future? The tool applies a 10-year historical compounded annual growth rate, which is fully customizable to project the property's market value each year and showing when it may double in value. So for this example, the annual growth rate we have is 9.8. So that is pretty high. So we can make it at 5% to be more conservative. And as you can see here, it's telling us that the property will double in value at 2040. So at 700,000 in 2040, that is projected to have a property market value of 1.45 million based on the 5% compounded annual growth rate. Of course, historical performance is not a guarantee of future performance, but it's a good way to benchmark performance. Your potential is key for wealth creation. Estimating capital growth let us plan our long-term gains and equity build-up even with conservative assumptions. I once compared two similar properties, one in an area with 4% compounded annual growth rate and one in a suburb with 6% growth rate. The difference in projected value after 10 years was over $150,000. That's the power of growth. How much equity will I build and when? So going back to our charts, we can see here what would be the estimated usable equity year on year. This helps us plan for equity release, reinvestment, or refinancing strategies. So knowing that our cash flow, we are going to be positive cash flow on year 10, which is on 2035, will be positive by $495, and our estimated usable equity will be $403,000, 669. Equity lets us invest again, refinance, or build wealth. Tracking usable equity over time helps us our next move and unlock future buying power. How much faster can I pay off my loan by making extra repayments? So by adding extra repayments, this will shorten the loan period of our loan. So let's say we are adding a $250 per month on top of our regular mortgage repayment. So the system automatically will show that adding an extra repayment of $250 per month will shorten our loan period by 3 years. So from 30 years down to 27 years. And we can see that in here as well. So the gray line is our original loan period. So let me just turn off those two lines. So the gray line is the original loan, and the yellow line now is the new loan period of 27 years because we are adding an additional repayment. And the shaded area here, this is the interest-only period of 5 years. Adding an extra repayment of $250 per month to our mortgage will shave off 3 years from our loan term, which saves us over $138,000 in interest. And this tool shows that impact instantly. How does switching between interest only and principal and interest repayment affect my cash flow? So switching from interest only to P&I repayment definitely affects our cash flow. So as you can see here, this is what interest only repayment looks like. And when we factor in principal repayment, or we can recombine principal and interest, this is how the cash flow will look like. Since we are on a 5-year interest only, on the 5th year, it will be less negative. But on the 6th year, it will be more negative again. The reason why is we started paying for the principal component of the loan. Many investors forget to plan for the jump in repayments when the interest-only period ends. Understanding this switch helps us prepare and avoid cash flow shocks. Is this a good property to buy based on 30-year profitability? Whether analyzing a property manually or by clicking the Analyze button from a property listing tool inside SuburbsFinder, the tool generates 30-year profitability report downloadable with charts via PDF, which summarizes for presentation or for personal planning. Looking at the short-term cost is only part of the picture. A full 30-year review helps us choose investments that stand the test of time and move us toward our bigger goals. Alright, here's that bonus tip I mentioned. Once we're happy with our numbers in the Property Analyzer tool, we don't need to manually plug them into the dashboard filters. All we have to do is to click View Suburbs icon, and SuburbsFinder will instantly use all of these parameters to narrow down those suburbs that matches our criteria. So SuburbsFinder narrowed down the areas right away. So right now we have 316 areas that matches the numbers in our property analyzer. So that's how to answer 10 key investing questions in one session. No spreadsheets, no guesswork, just data. If you want to stop guessing and start investing smarter, hit subscribe. And in the next video, we'll break down the data behind the next big growth suburbs. See you next time.